All right, everybody, welcome back to the show. We like to do these deep dives into the economic data that really matters, and today we're looking at the U.S. GDP report for Q3. Like opening the next chapter in the ongoing story of the U.S. economy. So much anticipation.
Yeah, exactly. It's been a pretty good run for the U.S. economy lately, outperforming a lot of the other G10 nations. Consumers are spending. Domestic demand's been strong.
Like a solid winning streak. So everyone was expecting another strong performance this quarter, but let's just say the numbers are in and they've got everyone talking.
Yeah, the actual GDP growth landed at 2.8%. So
Yeah.
decent, but a little bit under that 3% that most analysts were predicting.
Okay, so maybe not a complete stumble, but not quite the knockout punch some folks are hoping for. Before we get too deep into this, though, let's just take a step back, make sure everyone's on the same page. What does 2.8% growth actually mean in this context?
So basically, it's telling us the total value of all the goods and services produced in the U.S. during Q3. That increased by 2.8% compared to the same time last year. It's a pretty fundamental indicator of how healthy and what direction the economy is moving.
Gotcha. So growth is a little slower than last quarter,
hmm
but still positive. What really caught my eye, though, was the inflation data, both the GDP price index and the core PCE price index. They came in hotter than expected. Can you break those down for us? What are we looking at?
Think of the GDP price index like a thermometer for the whole economy. It's measuring the changes in prices for everything produced in the U.S. And that reading of 1.8% that we saw in Q3, that means things are getting more expensive. Inflation is definitely a factor.
And the core PCE price index, that's the one the Fed is always watching closely. Jumped up to 2.2%, even higher than predictions. Got to have the Fed thinking a little bit harder about their next steps.
Yeah, it definitely makes things a bit trickier for them. They're trying to find that balance between keeping inflation in check, but not completely stopping economic growth. And this data suggests that inflation might be sticking around a bit longer than they were hoping for.
Okay, so we've got slower growth and inflation that just won't quit.
Yeah.
What did the market think about all this?
Yeah.
What happened to the U.S. dollar when this news hit?
Oh, the dollar, it was a bit of a show. Then initially it dipped right after the GDP report dropped, almost like it was taken aback. But then it bounced back pretty quickly, ended up climbing to daily highs around 104.40. We also saw some movement in the yield curve. The short end and the belly, that strengthened.
Wait, hold on a second. For those of us who aren't quite as fluent in bond market jargon, what exactly does the belly of the yield curve strengthening actually tell us?
Sure, so think of the yield curve like a picture. It shows interest rates over different lengths of time. The belly is right in the middle. It's those interest rates that have maturities between 2 and 10 years. When it strengthens, it's basically investors saying they're feeling more confident about the economy, at least for the midterm.
Interesting. So even with growth slowing down a bit, investors are still feeling pretty good about the U.S. economy's future prospects. And you know what? Speaking of feeling good about the future, I think this is a great time to remind our listeners about something special we're doing here at the Traders with Edge podcast.
We are super passionate about helping people who want to get into trading. That's why we put together this challenge. It really tests your trading skills. And if you pass, we'll give you up to $500,000 to help kickstart your trading career.
Yeah, we walk the walk, right?
Yeah.
We want to see traders succeed. Okay, now back to this GDP report. The market reacted, sure. But what's your expert opinion on that initial dip and then the bounce back of the dollar? Is that a vote of confidence, or is it more about uncertainty?
That is the big question, isn't it? And it all goes back to what the Federal Reserve decides to do with interest rates. Everyone is pretty much expecting them to cut rates in November, probably by 25 basis points.
Which, for the folks at home, that means 0.25%. You got it.
But the market might have initially reacted to the GDP report thinking, what's the Fed going to do now?
Because slower growth and inflation's still there
Yeah.
makes it a tough call for the Fed.
Exactly. They're trying to figure out, do they focus on keeping the economy growing or do they tackle inflation head on? And the market is trying to guess what they'll do. And that's where all this volatility comes from.
So it's like we're all trying to read the Fed's mind, trying to figure out what their next move will be. And that's what makes this whole thing so fascinating.
You said it. It's so important to stay informed, see how all these different factors connect with each other. And then you can start to get a handle on what the market might do.
100%. So we've got this GDP report, markets doing their thing, and the Fed's next move is the big mystery. What should our listeners, especially those traders out there, be watching for the next few weeks, next few months? What are the key things?
Okay, first things first. Don't freak out over one single report. Yeah, GDP growth slowed a bit, but it's still growing. Inflation's still a concern, but we need to look for signs that it's easing up. And most importantly, watch the Fed, what they say, what they do, because it's going to have a big impact on everything, the economy, the markets, the whole shebang.
Great advice. And remember, knowledge is power, especially when it comes to trading. The more you understand what's happening, the better decisions you can make.
Couldn't agree more. If you really want to take your trading seriously, think about that challenge we offer here at the Traders with Edge podcast. We want to support traders, fun traders who have what it takes to make it.
All right. So we've gone over the GDP numbers, how the market reacted, and the big question mark that is the Fed. But what does all this mean for the average person? How should our listeners think about this report when it comes to making decisions about their own money? We'll dive into all that after a quick break.
Yeah, that's what it all comes down to, right? It's not just numbers on a screen. It's about the story behind the numbers and what that means for your money, your decisions.
Right, because at the end of the day, it's not just Wall Street that's affected. It's Main Street, too. People's jobs, their investments, what they can afford to buy at the store.
Exactly. So let's break this down. Growth is a little slower, but it's still growth. Inflation is hanging around, and the Fed might be getting ready to cut rates.
Okay, so let's try to visualize this.
Yeah.
What does this all actually mean for someone who is maybe thinking about buying a house or someone who's thinking about investing in the stock market?
For someone looking to buy a house, this report could actually be good news. If the Fed cuts rates in November, everyone's expecting mortgage rates could go down, which means it could be a little easier to afford a house.
Interesting. So even though the economy might be slowing down a bit, there could be some positives for some people.
Right. It's all about seeing the bigger picture, understanding how all the different pieces of the economy fit together. Now, for someone who's thinking about the stock market, it's a little more complicated.
How so? The market seemed to react pretty well overall, at least when you look at what happened with the dollar.
Yeah, but you got to remember the market is always looking ahead. It's not just reacting to what's happening right now. It's trying to predict what's going to happen next. So even though the GDP numbers weren't bad, the inflation thing and the possibility of more rate cuts from the Fed, that creates uncertainty.
Ah, I see. So it's like investors are saying, okay, things could be better, but they could be worse too. Let's just wait and see what happens before we do anything drastic.
Exactly. And that's why it's so important to understand these economic indicators, how to interpret them. It's like having a map to help you navigate the financial markets, and they can be pretty unpredictable.
Which is exactly what we try to do here at the Traders with Edge podcast, right? Give people the knowledge and the tools to not just survive in the markets, but actually make some good decisions.
That's it. We want people to be empowered, to feel confident making financial decisions, whether it's about their own investments or even thinking about a career in trading. Speaking of which, I think this is a good time to mention that incredible opportunity we have for our listeners.
You mean our challenge where people can actually win up to $500,000 in funding?
That's the one. We don't just talk about this stuff. We want to actually help people become successful traders.
Yeah, it's an amazing opportunity for sure. But let's get back to today's topic. We've looked at the GDP report, the market's reaction, and what it all might mean for the individual. Zooming out a little bit, what's the big takeaway here? What's the overall message of this report?
I'd say the big story is this. The U.S. economy is at a turning point. It's shifting gears, moving from that really strong post-pandemic growth to something a little slower. And inflation is proving to be a lot tougher to get rid of than anyone expected.
So like we're at a fork in the road.
Exactly. And like with any fork in the road, there's more than one way to go. The key is to pay attention to the signs, the signals the market is sending us, and be ready to adapt as things change.
So it's all about flexibility, being able to change your strategy when you need to.
Absolutely. And that's where the real skill comes in. It's not just about the numbers. It's about seeing the whole economic landscape and making smart decisions based on what you
said. So we've got this sense of change, this uncertainty about what's coming next. But uncertainty isn't always a bad thing, right?
Not at all. Uncertainty can create opportunity, especially for the people who are prepared, the ones who've done their homework and know how to navigate the markets.
It's true. Things change all the time. Yeah. And in the markets, the people who can roll with the punches, those are the ones who usually come out on top.
Exactly. The best traders are the ones who look at uncertainty and don't see a problem, they see potential. They're always learning, always adjusting their strategy, always one step ahead of everyone else.
So we've talked about the big picture, but let's get down to brass tacks here. What are some things our listeners can actually do to handle this transition period, maybe even find some good opportunities in all of this, what are some practical steps?
The first thing is stay in the loop. Don't just rely on the headlines. You got to go deeper. Read analysis from people you trust. Listen to podcasts like this one.
Of course. We do our best to break things down, give traders of all levels the info they need to make good decisions.
Another thing is don't be afraid to ask questions. If you don't get something, ask. There's a ton of information online, and you can always reach out to a trader who's been doing this for a while, or a financial advisor. Get some guidance.
And you don't have to go all in right away. You can start small. Practice your strategies without risking any real money. Or maybe open a small investment account. And as you get more comfortable and gain experience, you can gradually...
That's great advice. It's all about building up that foundation, developing your skills over time. Remember, trading is a marathon, not a sprint.
And speaking of building a foundation, I think we should mention that amazing opportunity we offer here at the Traders with Edge podcast. We're not just about teaching people. We want to actually empower them.
Yeah, we have our challenge. It's for traders who are just starting out but show a lot of potential. If they pass, we'll give them funding, up to $500,000 to help launch their trading career.
It's an amazing opportunity. We want to give talented people the resources they need to really take their trading to that next level.
Exactly. We're all about investing in the future of trading. And we're super excited to support the next generation of great traders.
So as we wrap up this deep dive into the U.S. GDP report and everything that comes with it, what are the big things our listeners should take away from this conversation?
The U.S. economy is in a transition. Things are slowing down a little bit, but inflation is still here. This creates some challenges, but also some opportunities for traders. And what the Fed does in the next few months, that's going to be key.
It really is like we're all watching a movie unfold, right? Except this movie is the economy.
Yeah. And for traders, the most important thing is to stay informed, stay flexible, and never stop learning.
I couldn't agree more. Folks, that's all the time we have for today. We hope you found this deep dive helpful. Remember, knowledge is power, especially in the markets. And we're here to help you gain that knowledge. Until next time, happy trading.